My next guest says we're already in a second liquidity crisis. James Ferguson is head of strategy at Arbuthnot Securities. Just how deep is that crunch and how deep is it going to get?
Well, you say it's a liquidity crisis. I mean, in many respects, what we've discovered in this crisis is that the liquidity crises reflect an underlying solvency crisis. So the first point I'd make is that I think European banks are facing a solvency crisis. And the trigger for a solvency crisis to turn into a credit crunch for the rest of the economy, for banks to actively start shrinking loans rather than no longer growing them, is to be told to recapitalise. So the order to tell a bank that's got a fundamental shortage of capital to recapitalise is exactly the same as the order to tell them to shed assets, and shed assets quite fast. What's accelerating this process, however, is the fact that that immediately triggers this liquidity response. For example, recently when the US money market funds that fund the European banks' dollar lending decided to pull their money back. It's worth bearing in mind, US banks have $6.5 trillion worth of dollar lending. European banks have $5.5 trillion. So they're almost identical in size, but they haven't got any dollar deposits. So we get this immediate liquidity crunch. So the Fed is immediately asked by Mervyn King to step in a coordinated way and give everybody, all the other central banks, access to dollars so that their banks aren't tripped up in the space of a weekend. But what we have here is everything in place for a very rapid credit contraction or asset contraction by European banks.
I mean, what's the timing on this? What is the trigger that you would look for if you were an investor worried about exactly this?
I think the timing is being told to recapitalise by June, but of course banks are starting to act on that already. We're already seeing banks adopt the various ways they can think of, for example, reclassifying the risk weightings on their assets, cheating, as is otherwise known. A couple of banks have had a stab at raising capital to see if it can be done, like UniCredit, but it doesn't look like it's going to work terribly well and it's going to be very expensive. For most banks, the obvious thing is shed assets, and we can see that happening every day. Little stories popping up all over the world. You know, European banks don't just fund continental Europe. Eastern Europe, almost entirely funded by European banks. Global trade, almost entirely funded by European banks. 21% of lending into Asia. So, you know, this is a big one, possibly bigger than the US.
Are we at a position that a major bank could actually fail within weeks?
Well, look at the EBA's stress test. According to the EBA's stress test, out of, I think it was 95 or 97 banks, the fourth strongest was Dexia.
Yeah.
You answer your own question.
Yeah, I know that. But that said, looking around the continent, is it the countries such as Spain, Italy, that those banks and financial institutions are perhaps most vulnerable to what you're talking about?
Not really. The trouble really with the way the European banking system is set up is that they decided to really wed themselves to the concept of risk-free assets, which of course allow them to wed themselves to the concept of very low capital positions. So banks in countries with a bit more of a history of being a little, they say, fair about paying money back, like, say, the Mediterranean countries, tended to hold and have still to this day hold a bit more capital than countries or banks within countries like, say, Germany or France or whatever. The trouble, though, is that the French and the German banks hold a lot of assets which are not domiciled within their countries, therefore are not necessarily governed by the same sort of Teutonic requirement to pay money back. So the biggest gearing is in France and particularly Germany. The biggest, problems are in the sort of Med. It kind of balances out that none of them look that strong.
Have the central banks done enough? Because we know the Bank of England last week reopened its liquidity lines. The ECB has reopened 3-year loans for banks, and we know about the dollar swap lines. Have they done enough? And if not, what else should they be doing?
Well, the thing is that what central banks can do is they can do enough to prevent a liquidity crisis tripping up any particular bank. When Northern Rock went, the Bank of England had the option to provide enough liquidity that Northern Rock was fine. The reason they didn't is because there's no point providing liquidity, well, that, and there's no point providing liquidity to a bank that's insolvent. And if you can't believe that it could get back to solvency in a realistic time frame, then maybe it's better to tide it all up and wrap it up. So what the central banks are doing is providing enough liquidity, hopefully, that we don't have any bank-run type liquidity events in Europe, although you can't stop the man in the street suddenly deciding to queue up. The much more important problem is that we're going to contain it in the way that the US and the UK contained it in '08. And that is, you provide the liquidity, you try and manage some banks being taken over by stronger ones, but I defy you to find significantly stronger ones in Europe. But by and large, you just buy time for the banks to get their house in order. And what's that look like? For the rest of us, that looks like a credit crunch.
And of course, very quickly, we had French banks being downgraded last week. The country itself could be downgraded this week. Will that going to make a significant difference?
It's my belief that everybody's concentrating on an issue or issues which are serious, but they're not actually the big problem. So yes, it's serious that the ratings agencies are always behind the curve anyway and tell you what you already know, might downgrade countries. Of course, it's serious that Greece might fall out of the euro and all the rest of it. These are all very serious things. To my mind, they're not as serious as the thing that no one's paying any attention to, that they've already done, which is trigger a European bank-wide credit contraction.
James Ferguson, Head of Strategy at Arbuthnot Securities. Thank you very much indeed. And of course, Linda as well. Many thanks.